fun times ahead. Okay, let's get started. Almost there, almost there. Good day, my name is Lakshya Behl. Welcome to Bell's Business Broadcast. So what a Monday, what a Monday. We woke up to yet another crash in the Bitcoin price right as we enter into the quantitative easing era of the year, of the multi-year quantitative tightening cycle. So today we're going to talk about what we know, what we don't, what nobody knows, how nobody has a crystal ball, how we are going to look at what's going on in the market right now. So let's get started. I want to start by sharing my screen with you right here. And this is the poor little Bitcoin chart right there. Congratulations if you bought Bitcoin on this bounce right here last week. Bounce from 80,000 all the way up to what, 93. Congratulations if you bought it right here, because now you're down again by what, 10%, 8%, something like that. You're down again. And why is that happening? Who cares why that is happening? The important point is nobody knows the future. Nobody knows what's going to happen over the short term. Even though you might have anticipated and priced in, you're not the only one pricing in the quantitative easing that is going to happen in the near future. So you might have priced that in, but so did the entire market. And now what we have here is another, looks like institutional dumping. We don't really know why this is dumping. We do know that short term, you can never really predict anything. Long term, what I'm seeing here is lower lows and lower highs. Can you see that right here? Lower low, lower low, lower low, then another lower low. Now let's see if it makes another lower low. And by the way, people talk about candle closes, but with the markets such as Bitcoin that operate 24 hours a day, you don't really know when the candle closes, do you? It's just an arbitrary thing. So for me, it's like UTC or London time. And for you, it might be something else. We don't really have a formal market close because the market never really closes. So here, the VIX actually indicate the truth instead of just the fat portion of the candle, which is open and close. The VIX aren't really scam VIX. They are really the momentum of the price going down. And if you look at the granular data, if you break this down instead of daily charts down to hourly charts, you're going to find that it can go down, stay down for a while. What we do know for a fact is the next support level is right here, which has been breached based on the volume profile. Okay, it was at $87,000, which has been breached. Let's look at the next support level then. And for looking at the next support level, by the way, if you bought Bitcoin, which I did during this particular, rise or this particular ascent, you are essentially down to zero growth or even negative growth over the last however many days is that. That's 218 days. So 7 to 8 months of gains completely obliterated. And that's the truth of cryptocurrencies and Bitcoin, especially over the short term. And this is Bitcoin, the king of cryptocurrencies, the one that is supposed to be the stable cryptocurrency. And it has gone down significantly over the last 2 months or so, right? This is just 2 months of declines. It takes a lot longer to go up too than it takes to fall down. And now if you try to make an entry without making an informed decision, it's like catching falling knives because, well, remember short term, nobody has a crystal ball. You don't, I don't, nobody does. So what we are looking at is the next support level. If you look at the volume profiles right here, the next support level is going to populate in a second, is around $67,000 and $62,000. These levels are the next levels of support. You don't really have a whole lot of things happening at the $75,000 level. at least based on the current volume profile, right? This is variable range volume profile. And the next support levels are there, and the next big support after that is at 43,000. And then things can always get worse. 40,000 and the next big support level at $29,000 level. Am I saying it's going to go down that far? I'm saying I don't know what's going to happen over the short term. I've never said or never claimed that I know what's going to happen over the short term. Can it go back up to a new all-time high, 140, 180? Yes. Is it likely? Possibly. We'll look at the macro factors, and macro is what determines the prices of speculative assets more so than anything else. Not fundamental news or fundamental analysis. I'm going to prove that to you conclusively today, so we'll have a look at that. But what we are noticing is that right now, should I take an entry? I don't know about you, but I'm not going to take an entry, even though it looks like it's at support levels right here. There is a bit of support at $84,000 level, and then there might be a little bit more at this level right here, $81,000, $81,000 to $84,000 level. But the crucial point would be whether or not Bitcoin continues to make a new lower low. Okay, lower highs, yes, lower high, lower high, lower high, lower high, a lower high. And now does it make a new lower low, in which case the trend breaks down? We don't really know, but that's just one factor. The key to successfully trading, at least in my view, is to look at a cohort of factors, not just one factor at a time. So if you're just looking at one thing at a time, you're not really looking at the entire picture. You're not looking at the full picture. You're looking at a segment of the audience at a time, or the segment of, you're looking like at a snapshot. So what you want to look for is clusters, and technical analysis only really gets you so far. What matters a lot more is macro analysis. I want to show you something right here. This is balance sheet, the federal balance sheet right here. This is the Wall CL, or federal assets, total assets held by the Federal Reserve. And this kind of corresponds to when or how much people are going to speculate. Okay, so when this balance sheet goes up, we have quantitative easing, and when it goes down, we have quantitative tightening. We've had a prolonged quantitative tightening cycle. Is actually unprecedented in recent times, since 2022 April all the way today, which is December of 2025. So 3.5 years of quantitative tightening. That's a lot of tightening. That's where money is being removed from the supply. And this chart basically determines a lot of what happens with speculative assets. And the more speculative the asset, the more correlated it's going to be with this. For instance, the altcoin market. Okay, so let's look at the altcoin market. And the way I look at the altcoin market is by looking at the total crypto cap, basically excluding the top 150 cryptocurrencies. If you want to look at pure altcoins, what you should be looking at is crypto total market cap. This is total 3, excluding Bitcoin, Ethereum, and stablecoins. Okay, so you are excluding Bitcoin, Ethereum, stablecoins. Yeah, total 3 ES. Now, what you're looking at is a correlation. Let's look at this correlation right here. Okay, quantitative tightening, and as you can see, the correlation, at least in my view, let me just link up these charts because these charts are not linked together. So yeah, interval, crosshair, time, and date range. Okay, so now they are linked, sort of. And what you can see here is this is what happens. The total market cap on crypto is actually increasing right here. Why? Because now people have priced in, this is my theory on this, people have priced in that we are going to have quantitative easing in the near future. So it's not like you're going to have a mega jump in terms of altcoin prices when this happens. Okay, this is all speculative right now, and this week is actually when we start to see, or we are expecting to see, some growth in federal balance sheet. But this is not guaranteed. This is far from guaranteed. It looks like this cannot continue forever because the unemployment rates are pretty high. We didn't have data for a while because of the government shutdowns, but the unemployment rates are pretty high. The inflation is still too high, but they are still cutting down on the rates. And while Powell said in his previous meeting, FOMC meeting, that it's far from a foregone conclusion that they're going to cut rates in the subsequent meeting, which is going to happen next week, 9th or 10th December, someday around that. What we're looking at is that they're cutting down on the interest rates. It's kind of priced in, but also there's a lot of uncertainty there. Okay, and let's look at the factors that actually heavily correlate. So the factor we are really looking for is the dominance of other tokens. So others.d. So excluding top 10, what is the dominance of other tokens? And dominance basically means the percentage of market share that these tokens or the altcoins control compared to all the top tokens, or compared to the entire crypto market in general. And you're going to see a great big correlation right here. So let's switch to monthly chart right here, or weekly chart right here. And I think the correlation becomes pretty clear as, look at this period right here. As quantitative easing happens, generally speaking, during the same period, you're going to have increasing dominance for the altcoin market. Altcoins gain market share when quantitative easing happens. When quantitative tightening happens, look at this chart right here. What's happening right here? Well, it's pretty obvious, right? So from let's say August of 2019 to June of 2022, we had quantitative easing, relatively high quantitative easing. Of quantitative easing is basically essentially releasing monetary policy, setting monetary policy to release money into the markets, and that is where speculative assets shine. These are often very brief windows, and people call it altcoin season, and they try to correlate or find correlations between Bitcoin halving and altcoin seasons, but that's not how things work. Things are more governed by the government policy, by the fiscal policy, than they are by narratives that people buy into. In fact, it's very easy to find people who buy into narratives like HODL or diamond hands, or I'm just so bullish about the gaming industry or the AI industry or the real world application industry within crypto, right? Or blockchain development, or L2s or L1s, layer 2s, layer 1s. People are married to those narratives, and you look at what happens to those people. Okay, they end up holding the bags while the whales dump on their heads for years. That's been going on forever. Crypto altcoin market is essentially PvP. So what you're doing is, it's like being in a casino. Okay, let me pull up my screen just so we know what we're talking about. This is PvP. Okay, this is you, this is other people, and then there are the sharks. And forgive my drawing, but that's a shark. Okay, just assume that's a shark. The shark is gonna sell. When are they gonna sell? When they have macro headwinds. In fact, they're gonna try to sell before those headwinds appear, which is why you see right here in the previous, let's say, alt season, as soon as the top appeared right here. Now, forget about this. As soon as the curve changed on the vol CL on federal balance sheet, right? As soon as the curve started maxing out, you see people started dumping. And by the time it became clear a few months later that quantitative tightening was in effect, you had already lost more than half your gains if you had hodled through this. In fact, hodl is not a strategy. You might be married to hodl. You might be married to narratives, okay? You probably are, even today. But if you're married to HODL, if you're married to narratives, let me just... If you're married to HODL and if you're married to narratives, you know what's going on with your portfolio, right? Kind of easy to see what happens when you're married to your portfolio. Whales will dump on you. And when you have other people who are also married to portfolios, well, some people win, some people lose, but on the whole, this whole cohort of people who are married to narratives tend to lose. Whereas people who are not married to any narratives continue to do well, and that's what we are looking at right now. So what are we looking at right now? Well, what we are looking at is quantitative tightening that has been going on for a while. And when quantitative tightening occurred or does occur, you can see what happens to the dominance basically of altcoins, right? So this is the altcoin dominance. This right here is 26% tightening on vol CL. Vol CL is a great indicator of tightening or easing, right? And you have had this massive dump, which, you know, that's a 65% dump in the dominance by market cap of altcoins altogether. You see, this pattern actually always holds. There may not be enough data, but this pattern almost always holds. Look at this period right here. This is where quantitative tightening happened, and look at what happened to altcoins down here. Quantitative easing always correlates to markets going up for speculative assets. The more speculative or risky an asset is, the better it does during the short windows when you have clear quantitative tailwinds or easing. When you have headwinds or quantitative tightening, these things crash. How many cryptos do you know that have crashed by 90, 95, 99% during this window when crypto tightening has been taking place? Now you can see the curve is flattening out here. So it's making a minima right here. It's going to tend upwards. That's what it looks like, sooner rather than later. And that's actually part of what happens inevitably. When you have too much quantitative tightening, you have job structures that are not so well. So let's look at the unemployment data. Let me just look at the unemployment data right here. And we have rising unemployment data right here. So can you see the clarity right here? And the period we should look at is actually a month. So let's try to look at 1 month. Okay, and this is also a month. So we're looking at monthly right here. So as you had quantitative tightening and high interest rates, you also have increasing unemployment rate. Now, it's not quite as bad as COVID, which was tackled, of course, through quantitative easing, because that's what we know. The government solution to everything is print money. Okay, money printer goes brr. That's that's their solution to pretty much everything, and that's going to be the solution this time too. And when that happens, you know, when the money printer starts, you have quantitative easing, you have low interest rates. Now, am I saying we're going to see interest rates that we saw during COVID era? Probably not. That's unlikely. Why is that unlikely? Because those were just a generational gift if you were able to capitalize on those. I personally was not even able to capitalize on those as much as I wanted to, but those were a generational gift and might be decades before we see those 0%, 2%, 2.5% mortgages ever again and 0% federal interest rates ever again. So low interest rates, you have low unemployment, so people are happy, and inflation's high. You can't really control that because money printer is going up, but inflation being high doesn't really bother people as long as the bills are paid. Bills paid, I'm happy. You know, that's the average guy right there. He's very happy if the bills are paid, even if it costs more, if he's making a little bit more, if he's unemployed, if he's not unemployed, if he is gainfully employed, he's happy with that. And what happens is speculative assets go up. Gold, in fact, either stagnates or even sometimes goes down because people are just dumping it. People don't need that security anymore. But that's not what we are looking at right now. Gold is at an all-time high right now. So let's go through the top news for the weekend, and as we go through them, we are going to run some more analysis on what's going on, and this is going to help clarify the situation. Now, I have to preface this by saying that I don't have a crystal ball of any sort whatsoever. I don't know what's going to happen in the next few months. What I can tell you is that I'm going to be prepared no matter what happens. Let me say that again. If Bitcoin goes up, great. If we see a new QE cycle or quantitative easing cycle, I'm prepared. If there's more quantitative tightening, awesome. I hope it crashes down to 40K or 29K and I can buy a whole lot more Bitcoin at those price levels. And if it doesn't crash, if it becomes more expensive over time, so be it. I don't need to predict the market over the short term because I'm prepared to deal with both macro headwinds and tailwinds. Whether the interest rates go up, remain flat, or go down, those events are hard to predict over the short term. Short-term noise is actually pretty high. So what happens over the long term, though, is that things tend to go up massively. In fact, you can see that right here. Let me show you. So let's compare the Bitcoin chart to quantitative tightening cycle. So in the beginning, when quantitative tightening began in 2022, you saw this Bitcoin crash right here. That was just exhaustion. Market gets exhausted because they don't have any more speculative money to invest in assets such as Bitcoin. But then after a while, it started consolidating over here. And even though we've had a quantitative tightening cycle all through this period, what we are looking at is Bitcoin going up. And that's not just Bitcoin, it's also SPX, which goes on to prove what I keep telling you, that Bitcoin and SPX and a lot of assets are not considered speculative by investors anymore. In fact, as institutions pour money into Bitcoin, they continue to buy Bitcoin and hold them over the long term. Bitcoin's position continues to get stronger as a long-term store of value, which means it's not quite as speculative as you would think. Same thing happened with SPX. Look at this right here. We've had consistent quantitative tightening, and yet Bitcoin and SPX went up by 82% during the same period right here. So the Federal Reserve was tightening its balance sheet or getting rid of assets on its balance sheet every single month or every other month. And during the same period, SPX made new all-time highs pretty much consistently. And this was also during Michael Burry telling everyone that you're going to have a crash, you're going to have a crash, you're going to have a crash. He told people that we're going to have a crash at least a bunch of times, half a dozen times, maybe a dozen times. And like I said, he's been right all 0 of the 20 times he's predicted a crash, because the crash never came. Why? People consider this to be a safe asset. Well, let's look at gold. Okay, gold, US dollars per ounce. Now what you're seeing is gold has made an all-time high of 4,200 whatever $38 today, slightly higher at the all-time high position. And this is what happens when you have uncertainty, when you have headwinds, when you have quantitative tightening. People are not so sure about the future, but they have high inflation. They like to buy gold. When people are sure about the future, when people are actually having this party, I like to call it a gravy train, the gravy train is rolling along comfortably, that's when you have, well, gold stagnates or goes down. And people don't believe me when I say gold goes down, but look at this period right here. This is a pretty long period. Let's expand this chart right here. This is a pretty long period right here. So gold went up to 1,900 bucks, then crashed down to whatever, 1,100 bucks, 1,200 bucks right here. And this was across several years. This was across 5 years. So we are looking at data from 2011 all the way to 2016. Yeah, that was my memory as well, right off the top of my head. People actually looked at the value of gold per ounce crash from about $2,000 to down to $1,000. In fact, it took another 5 or 6 years to get back to the same level. So right here, this was 2020. So over 10 years, people made almost no money on gold. Okay, if you held from this point to this point, you made 3% over almost 10 years. That's almost nothing. But when gold broke through, and this was when things were really bad for other assets, and quantitative tightening and inflation were going hand in hand since March of 2024. Now gold has done a 100% bounce or gone up in value. Some people like to think of it as a spring, right? If you compress a spring, it stores energy. So the price of gold is like a spring. When you hold it back for too long, eventually it just expands for a while. Gold bugs are very happy with the performance of gold. And actually, if you compare the performance of gold versus Bitcoin, there's something very interesting that has happened over, well, over the long term. Gold has essentially gone to 0 against Bitcoin, right? But over the short term, over the last few months, gold has outperformed Bitcoin for a while. This has made gold bugs really happy. But what was essentially going on, and this is just my opinion of the thing right here, what was essentially going on over there was gold was going up because of the uncertainty and high inflation, and Bitcoin was kind of flailing around, not really doing too well because we don't have quantitative easing. So in other words, there are hierarchies here. Gold is considered to be more speculative, less speculative than Bitcoin. Bitcoin is considered to be less speculative than the altcoin market. SPX is somewhere in between of Bitcoin and gold. And so this is your hierarchy. On the top you have gold. On the bottom you have alts. Actually, on the bottom you have meme coins. And they're great. On the top you have gold, then you have SPX, then you have individual stocks, big ones, blue chip. Then you have Bitcoin, Now this position is actually, the position number 3 is being contended by Bitcoin against individual stocks. But for now, individual stocks such as blue chip stocks, Nvidia, Tesla, Apple, whatever, right? They actually act as a stronger hedge against the markets than Bitcoin does. Bitcoin is still far more volatile, but we are looking at the S curve of the Bitcoin. Something to worry about over the long term. Eventually, I think Bitcoin is going to replace individual stocks as being more stable against the headwinds and tailwinds of the macroeconomic structure of the economy. But for now, this is how it is. Then you have, basically penny stocks. Okay, then you have alts, and then you have meme coins. Another thing to notice is that alts are essentially always going to tend to zero versus Bitcoin. Now, if you are a fan of Ethereum, you're gonna hate this. If you are a fan of Solana, Sui, any of the big alts, you're gonna hate this. If you're a fan of Zcash, which is a newer one, which has been doing really well right now, you're gonna absolutely hate this. But let's look at the trends, okay? Let's just talk about trends instead of just talking about, theories. Okay, so let's look at Ethereum versus Bitcoin. Okay, let's see. I want to make sure that we are doing the correct thing here. So ETH USD, that's the chart of ETH versus USD, and then we want to divide it by BTC USD. So we are essentially comparing the price of ETH to Bitcoin, and let's take 100 ETH because it's significantly cheaper than Bitcoin. Look at this chart. Now we're looking at this chart right here. What does it tell you? Well, to me, the picture is pretty clear. It goes up once. It went up once in July of 2017. The ratio was 15 or 15% of Bitcoin value, right? Then it crashed all the way to 2%. Then this was the other alt season right here. So this is another way of telling whether you are in alt season or not. You're going to see a clear upwards trend in the value of ETH versus BTC, or Solana versus BTC, or BNB versus BTC, okay? And it went up to a top of 8% of the value of Bitcoin, and then crashed again all the way to 2%. And then it went up during a fake alt season, because remember, we did not have quantitative easing right here. This was not backed by quantitative easing. This was all speculative based on the analysis that people had, this confusion between correlation and causation. Oh, you have halving, therefore every 4 years, roughly 4 years, you're going to have an alt season. Well, how did that play out for you? How did that play out for you? It didn't play out very well for you, right? So we don't have a halving driven alt season. If that were true, every single cryptocurrency that is being burned or has lower supply over time would have skyrocketed. But that's not what drives the demand. Just because you have a low supply of something doesn't mean the demand is also expanding. Bitcoin has had institutional expansion, which has driven the price upwards despite quantitative tightening. We've had the price go up from $16,000 to $125,000 back to $85,000 today, despite quantitative tightening. Why? Because of adoption. Adoption is the other factor. It's got nothing to do with the halving. Halving is going to happen every 4 years, or roughly every 4 years for the next 100 years. But that's really going to be the fact that halving was correlated to alt seasons or crypto cycles or crypto seasons was essentially just a misattribution. Okay, people misattributed to halving what they should have attributed to quantitative easing and liquidity cycles. This time we did not have a liquidity cycle, and clearly we did not have a real alt season so far. We haven't had an alt season at all. Have you seen all those people on Twitter talking about making 50x, 100x, starting with 2 Ethereum or 2 Solana and building up to 100 Solana? Well, they've got something to sell to you. In most cases, they've got a membership or a Discord or a program or some sort of an info product to sell to you. They don't really know what's going on in the market. Nobody knows what goes on in the short-term market. What you do know is that you haven't had quantitative easing, which is why this was a fake out. And again, Ethereum is going down. It wasn't just Ethereum. You can look at Solana. So let's replace Ethereum by Solana. Solana USD. Let's go into crypto. Solana USD. Okay. Do you see the same chart? I see the same chart. The exact same pattern right there. Solana, it was launched, then it went from, actually let's multiply that by 1,000 instead of 100, because Solana is significantly cheaper than even Ethereum. Okay, and so you're looking at, let me just remove this labels. Okay, so you're looking at Solana versus Bitcoin. 1,000 Solana compared to the price of 1 Bitcoin. It went from, well, 0.1 all the way up to 4.5. Okay, this was the first alt season, and this was correlated to quantitative easing. And actually, just look at that. Let's look at that. Okay, look at this quantitative easing right there, plain as day. As federal balance sheet expanded, so did the value of Solana versus Bitcoin. That's your alt season right there. And then we had another fake out over here. It's the same little fake out that you saw on Ethereum. For Solana, it was a little bit more prolonged, but notice how it never achieved the previous all-time high against Bitcoin, which is why I keep saying all altcoins tend to zero against Bitcoin over the long term. And it achieved a top of 2.88, which was less than half, or roughly half, of what it achieved previously. And then it crashed again. We had a little bit of a fake out here, but these are just fake outs. On the long enough time scale, what you're looking at is that every altcoin, there's not just one altcoin, this is every altcoin, okay? Every altcoin versus BTC. This is time. This is alt compared to BTC. And when it's launched, even if it has fundamentally strong economics, it goes up like this. That's your alt season, the first alt season. Quantitative easing. Then it crashes to some level. Okay? That's your quantitative tightening cycle. So when there's not a lot of money for speculative assets, this is what happens. Then it goes back up again and does way better than Bitcoin for a while, for a short window right there. But that's again quantitative easing. Makes another top, goes down. And then we don't really have that much data about most cryptocurrencies because crypto is a pretty new industry. But here's what it looks like it's going to happen. You're going to have another cycle of quantitative tightening. This is your tightening cycle right here. Then you're going to have another cycle of easing. But you know what it looks like to me? This looks like lower highs. On a long enough time scale, everything tends to zero against Bitcoin. Maybe it's not lower lows. I'm not sure about that. We're going to have to wait several years and several cycles of quantitative easing and quantitative tightening to solidify my understanding. But here's what I think happens. This is what happens. Over a long enough period of time, even if an altcoin does really, really well, it tends to zero against Bitcoin. Alt versus altcoin compared to Bitcoin price will always tend to zero. That appears to be the current understanding, the correct understanding right now. Can this change? Sure. Can you have fundamentally a very divergent experience with this? In the future, anything's possible. Has it ever happened in the past? No. Show me anything. Let's look at another chart right here if you are interested. And let's look at, let's say, SUI. By the way, if you're watching live, if you have any questions about that, if you don't agree with that thesis, go ahead and post a comment. Let me know. Okay, SUI. Now, this is a new thing. So it hasn't even had the chance to make its first all-time high against Bitcoin. But let's see what it does. My speculation is it does the same thing that every other altcoin does. And let's look at Binance token, BNB. BNB has been around for a while. So Binance versus Tether. Tether is USD, it's essentially a proxy for USD. And actually, Binance has a slight divergence from the whole thing. It made an all-time high here during the quantitative easing. Then there was tightening. Then there was easing, and it went all the way up to 17 Bitcoin, right? 17 Bitcoin for 1,000 Binance. We're looking at 1,000 Binance compared to Bitcoin. And then it crashed. But the pattern remains the same. You know, this is when the quantitative easing was taking place right here. This is the quantitative easing place. Okay. Let me move it up. It lines up perfectly. Quantitative easing, then tightening. And then there was a fake out, but then this was a fake out driven by speculation related to Bitcoin halvening, where you get half the rewards per block that you used to get previously, right? This has been essentially misattributed or miscorrelated to alt seasons and crypto alt cycles. And so that's what we see with everything, with Bitcoin, with Ethereum, with Solana, with everything. We've seen the same thing. There was a little bit of a fake out and then it went back down to zero. Now Ethereum has broken out. Binance token has broken out again. So let's see how that plays out. But over the long term, I guess everything continues to behave like this. This is going to be the chart versus Bitcoin. However, there will be short windows when you have everything lined up, right? So you have quantitative easing. Okay, everything lines up. You have quantitative easing. That's the first factor. That's what you need to know. Lower interest rates, right? That's the second factor. When you have that, the third factor is lower unemployment numbers. Okay, that's the macro factors. The crypto specific factors would be BTC.D, or the dominance of Bitcoin with respect to how much its market share occupies a percentage of the total crypto space, continues to go down, while BTC versus USD either holds or goes up, just not as quickly as altcoins are going up. And things are very speculative, and you can see that on the stock market as well. It's not just the crypto market. You're going to see that on the stock market as well. Everything is going to skyrocket. Basically, it looks like everyone is having a big giant party. The gravy train is going full throttle. That's when you can make money with altcoins. But make no mistake, that's going to be a very short window, as it has always been. It's going to be a very short window, and then it's going to crash. It's always going to crash. Everything is going to crash in the crypto world, especially because you don't have anything to prop up the value. You don't have any dividends. You don't have any real world utility for almost all these tokens. Even Bitcoin took a while to find its utility, and that's all just narrative, right? It's now digital gold. It used to be, oh, we're going to have transactions on Bitcoin. It's the internet money. Well, that didn't play out very well. So it took Bitcoin a few iterations to find the narrative that stuck. And I am someone who doesn't buy into the narratives, but you can buy into any narrative that you want. What you cannot do is ignore the reality that eventually everything goes down to zero against Bitcoin if you're in the altcoin market, and altcoin seasons are correlated to liquidity. Okay, so let's look at some news items now. The first news item, of course, is about Bitcoin tumbling sharply, which we already talked about. And this has triggered nearly $1 billion in liquidations again. Why can't people stop doing their leverage trades? Are you really making that much money? I mean, I gotta know, if you're making that much money with leverage trades, that you're okay with losing a lot of money every time the whales decide that it's time for you to lose money. I'm missing something there. Okay, I'm missing something. I went down to 84,000 because we've already seen, at 84,000 you have a support level. Okay, based on volume profile. So let me expand this chart for you. Based on volume profile, you already have a support level at 84,000. Okay. Are we looking at, yeah, we're looking at the monthly chart. We should be looking really at the daily chart with Bitcoin, or at least weekly, because we want to have some granularity. But as you can see, based on the volume profile, which is going to come up in a minute, we had some support here at the $95,000 level. So you can see price hung around at the $94,000 level for a while, and now we have some support at the $84,000 level. So it crashed down to $84,000 level. It's back up at $86,000 level right now. There's nothing really stopping it from falling down to $68,000 level. It's gonna depend upon macro headwinds versus tailwinds. If we have tailwinds, it can go up There's not much resistance up there apart from one at 95,000, a little bit at 104,000. There's not much resistance up there because we don't really have any price data. It's never breached those price levels. Can it go up? Yes, it can go up really fast. Can it go down? There's no way to predict what happens over the short term. So, we've already talked about that. Let's look at also the stocks. Global stocks are falling because of Fed data. Well, federal data or interest rates and quantitative cycles, liquidity cycles, drive more than just Bitcoin. You remember this chart of hierarchy that we did? Gold is great. When people are afraid, they invest in gold. When people have just too much money, okay, disposable income, disposable dollars, and when they have just certainty, so their gravy train is going on full steam ahead, that's when they buy meme coins. And then we have hierarchies. Bitcoin and SPX are in the middle, stocks, big ones are in the middle, penny stocks and altcoins are at the bottom, meme coins are at the very bottom. When you start seeing or hearing news about, oh, someone made a X million dollars from a $10,000 investment or $300 investment in whatever XYZ meme coin, that's when you know we're coming to the close of the alt season. We're coming to the close of the alt season because people are already into meme coins and they have massively expanded their bags in the meme coin. Now, most of the people who make money in meme coins and altcoins are going to round trip their entire gains because, as we've seen, the crash is inevitable. Macro headwinds are going to show up sooner or later. But over a long enough period of time, we also have some idea about what's going to happen. We also know over a long enough period of time, money printer goes brr. That's the only political solution. Why? We're always going to have deficits. Now, we're going to talk about a news item where Elon Musk is talking about how we can no longer have deficits using AI and technology. And we'll talk about what that means for you if that plays out, what that doesn't mean for you. If that plays out, we'll talk about that in a minute. But for now, we know we're always going to have deficits. We always know that we're going to have deficits over a long enough period of time. Human ingenuity, right, or human creativity is going to create new, massive, skyrocketing ventures. It's just going to happen. We know that for a fact. We also know for a fact that there's a correlation between, and you can go back to historically any era, there's a correlation between fiat printing, it's actually very highly correlated to population decline. When money printing happens, historically all the way back to Rome, you can check the records on that. In fact, I'll try to compile some resources on that over the next few streams. So if you're not subscribed, this is a great time to subscribe so you can follow me on deeper analysis on what happens inevitably. This is inevitability that we are talking about. What's the inevitability? As fiat currencies go brr, over the long enough period of time, population goes down. The birth rates decline. We have birth rate declines. And China and Korea basically are front running the world right now and showing us what's going to happen if you continue to keep printing money. Even if you have productive, law-abiding, large swaths of population that are completely married to the idea of having a great economy, a great country, completely loyal to their countries, very nationalistic, very, unified in a way, even then you're going to have rapidly declining birth rates. In fact, I hear about a potential case, a potential scenario where within a century from today, we might observe a 90% collapse in population. Now, is that going to play out? I don't know. But are we seeing a birth rate collapse right now? Yes, we are. Is it correlated to fiat printing? Yes, it is. Why? Things get expensive. People lose hope. It's inevitable. Okay, but since we're talking about inevitability, let's see what else we know is going to happen. The government really has no other solution. What are they going to say? Let's cut government spending? Which politician do you think historically has ever said that? There may be a few exceptions. They probably got taken out at some point of time. But if people are talking about tightening the seat belts or tightening their belts, cutting down, making sacrifices, and if these people are politicians, they're not going to be able to stay in power for very long. They simply cannot. My watch is telling me it's time to stand, so that's a great use of technology. Anyway, what we're looking at is the inevitability of just continuing to print money, as helicopter Ben or Ben Bernanke once said, that I'm gonna shower money down on people from a helicopter if I have to, in order to keep inflation going up and the economy going up and the GDP going up. GDP, by the way, is numbers on the screen. If I give you $10 and then you give this guy $10 and this guy gives me $10 back, well, what happened is that one $10 bill got circulated between us, but that just created $30 in taxable events as well as taxable or reportable GDP growth. So that's how GDP works, and it's even weirder than that, but we'll talk about that some other day. So what are you going to have? Well, you have a huge, enormous debt problem, right? How are you going to solve it? Well, you can collect taxes and you can cut spending if you're the government, but your spending is greater than your tax collection revenue. So what are you going to do for the balance? Like, where are you going to get the rest of the money? You just print it. You have to. And you do it through a variety of different media or different methods. But the point remains, money printing is inevitable. There's no way around it. When money printing does happen, you do eventually tend to have those quantitative easing cycles. And when you have those, well, everything does get expensive. So you have to control that inflation. It's sort of like a balancing act, but you have to let it happen. Why? Because GDP is going up, people are happy, and you need to make people happy if you want to get reelected. Right. Now, I'm conflating the Federal Reserve with the government here, but the point remains, in most cases, whether it's Democrats in power or Republicans in power, right? Left wing, right wing, blue, red, it doesn't matter. Eventually, the debt ceiling does go higher. Okay? We've had shutdowns about this issue. What is inevitable is that despite all the political theater, eventually the debt ceiling does tend to go up, which means higher debt, which means borrow more money from the future. When you borrow money from the future, you don't really have much of a future, but who cares about the future, right? You just care about the next upcoming elections. And if you're not careful about those elections, like the Republicans weren't in the gubernatorial elections last month, what happens then is that they lose the power. And then the other side does the same thing all over again. So inevitably, you're going to have quantitative easing and quantitative cycles. They continue, but the value of the dollar, but the value of the fiat currency always tends to zero. That's the other thing we always know about. This is time. This is value of, let's say, $1. Okay. The purchasing power of $1 always goes to zero over time. And that's not just dollar, any fiat currency, really, any currency. So it could be GBP, it could be euro. Over a long enough period of time, anything that is not gold tends to go to zero over time. It's just inevitable. And the assets that you have tend to skyrocket in value, even if the utility that these assets have does not increase. Why? Well, because there's only so many assets to go around. You can't really print assets as easily as you can print money. What does that mean for you? Well, we'll look at that. We'll look at that. Let's keep going. Musk says AI will solve the US debt crisis within 3 years. Okay, he said, I think the only thing that can solve the debt situation is AI and robotics. Currently, the US debt is insanely high and the interest payments of the debt exceed the entire military budget of the US. Just the interest payments, and that's true. That's statistically true. Debt payments also outpace defense, and all sorts of other spending. But how AI is going to solve that is speculative. What he's kind of proposing is that AI is going to increase the productivity of mankind or of the industry so much, of major industries, several major industries, so much that you're not going to need human labor to be able to Yeah, that's really all it is, right? If you have AI, if I have AI that can do the job of a bunch of people, an entire team of people, well, what will I do with those people? I'm just gonna let them go, and I'm gonna have AI on wall time continue to work for me 24 hours a day now, without getting sick, without taking a break. And if it's good enough and the product it produces is good enough, then I'm all for it, right? As a business owner, I'm all for it. If you're a business owner, if you're not using AI, I keep saying this in every single stream that we have, in every broadcast we have, if you're not using AI, AI is the opposite of a moat for you. Your competitors are using AI, so you should be on that too. You should be experimenting with how you can use AI to make your workflow more seamless, to make your company more streamlined, because eventually, if you don't, your competitors are, they have a massive advantage over you. So AI is not a moat that you're going to build around your business. It's the opposite of a moat if you're not building it, because everyone else sooner or later will be jumping on the bandwagon. And it's a very productive bandwagon if you can get it to work. Here's the problem with this, okay? People are skeptical. So while AI will boost productivity, this is a Nobel laureate. He's saying while AI will boost productivity, it will also create massive unemployment and a huge rise in profits that enriches only a small number of elite. That is absolutely true. And I'm going to show you some data about that. So what he's saying is that AI will make a few people significantly richer and most people significantly poorer. Okay, so while Musk may be right that AI might get to a point where it actually replaces a lot of human beings and increases our productivity, global productivity tenfold of the industries, it's going to eliminate the need for hiring people in a lot of cases. And yeah, that is just something to think about. In fact, Wall Street is already warning of a K-shaped economy. You know what a K-shaped economy is? Well, people on the top, they make more money, right? They keep getting richer, rich get richer. This is the rich getting richer, and this is the poor getting poorer. So rich make a lot more money. Poor keep making less and less money, while inflation being inevitable and money printing being inevitable, things keep getting more and more expensive. What happens when you borrow too much from the future? You don't have a future left. There's no doubt about that correlation. That's a correlation that has held across centuries, across different economies, across different empires. This has always been true. You can go and do your research on this, but this has always been true. What happens now is as more and more people employ AI within their businesses, they're either going to be categorized as the top. This is not half, by the way. This is the top 1%, maybe top 10%, let's say top 5% of the people taking advantage of AI and the modern technology. And this is just everyone else. Everyone else is sliding down. That's just inevitable. That's how it goes. There's nothing you can do about it. I want to make sure that we are actually recording this, not just streaming it. Yep, we're recording it. Okay. So that's actually correct. The phrase has proliferated across Wall Street as economists and executives grapple with the conflicting signals. Growth appears solid, yet consumer confidence plunged to 88.7 in November, its lowest level since April, according to the Conference Board. The stock market hovers near record highs, all-time highs, with year-to-date gains that are around 17%. That's huge, right? But the factories are shedding workers and wage growth is slowing down. Wages have been stagnating for a long time and wage growth is slowing down. Moreover, the employment numbers are going down or unemployment numbers are increasing. Remember, the official figures about unemployment are not the full picture. The official numbers about unemployment really just talk about people who are looking for employment. A lot of people are just signing out or just trying to do their own thing. They don't make the unemployment numbers. But at the end of the day, there are a lot of people who are not working at all. And the consequences of that are pretty dire. We should be talking about the consequences of that. So here's what I did. Actually, let me just show you what I did. I had a discussion with Perplexity about this. Perplexity is a great AI for researching data if you're into that kind of stuff, right? So Here's what happens when people become redundant. Now, 100 years ago, something similar happened with horses and equine populations. This sounds very dystopian. This sounds very painful. In fact, it's almost offensive that I'm going to compare human populations to equine populations now, but bear with me for a moment, okay? I asked Perplexity what's the data on number of horses in the US today compared to 100 or 200 years ago and charted by the decade. First of all, I want to just show you the chart. This is the chart. From 1860s all the way to 1920s, there was a steep rise in the population of horses. Now, this is millions of horses, 25 million horses. Keep in mind, this is not in comparison to the population growth as well. Okay, so this is just the number of horses. You have to understand that the population has been exploding since 1920 while the number of horses has gone down. Why? Because automotive, let's say engine, internal combustion engine, pretty much replaced horses. What happened to the population of horses? It declined from 25 million all the way down to less than 2 million around 1980 and 1990s. Now the horse population has gone up since then, right? Horse population has gone up since then, and that's the first thing I want to talk to you about. This part of the curve, this is kind of misleading. Why? Because what I asked Perplexity to explain what is attributable here, right? So what factor is attributed to the growth in equine population since the late 90s? And the main drivers are basically late 20th century increase came from more horses being kept on smaller part-time farms and non-farm properties for pleasure riding. Horse is no longer a utility. People needed horses to move around until bikes and cars came around, and now people don't really need. How many times do you see someone riding a horse just to get from point A to point B? It's just senseless, right? It does happen, but it's senseless. Now you do need some horses on the farms, right? But outside of that, the horse population increment has been attributable to just pleasure riding, people just riding horses for pleasure. So there are supporting data points, and I'm gonna link those to you later on. But the point is, this is just recreational and hobby use of horses. Now, let's actually ask something else, okay? Give me the same chart, but adjusted for US population. So equine population as a percentage of US population. And if that's too small, then maybe per capita 100K people. Okay, let's see what it comes up with. So what I'm really saying is, even though the population expanded, nobody needed the horses anymore, and the graph will probably look even worse than it did when we saw it over here, because this is just the raw numbers. It doesn't account for the number of people who are going to be having this ownership of horses, and that will actually decimate the argument of recreational use increasing the equine populations. And the point here is not about how many horses exist. The point here is what happens to cohorts of things or people or populations when those populations become redundant or useless. And that's a very harsh take on the world, but I like to go into the world with a wide-eyed realism instead of being wide-eyed optimistic about everything in the world. So look at this curve right here. So we are now looking at US equids per 100K people, okay? And went up, people actually owned more horses over time. That was wealth increasing and productivity increasing. But then cars were invented, internal combustion engine came around and went down, and now look at that. It's actually hovered around 2,500 horses per 100,000 people. Okay, that's just terrible levels of what happens to useless cohorts of populations of any kind. Now, am I saying things are going to be just as bad with human beings? To be honest, yes, I am. I am saying that things are going to be just as bad with human beings, and we are already seeing that with declining population curves everywhere in the world. When people are no longer needed for the industry, what are people going to do? And people actually, nobody has to go out and cull the populations. You have to understand this. Nobody's actively doing anything. All that is happening is that people are just not able to afford houses, not able to live a decent lifestyle. And so then the concept of having kids becomes a foreign concept. It's something to be done way down the line when things work out. Except, economically speaking, or on a macro scale, things are not going to work out for vast cohorts of populations, and we are seeing rising childlessness in the world. We can have Perplexity do the research for us. Can you do research on childlessness in the US since 1990? Stats and graph on an annual basis. Okay, let's look at that. Things are getting expensive. Remember, why are things getting expensive? Because the political solution is inevitably more and more money printing. So what we're going to see is right here, we're going to look at what happens when things get more expensive and money printing just continues, and you're continuing to borrow from the future. Well, you don't have much of a future left. That's what I keep saying. People think I'm being very cold about numbers, but this is just historically valid. This is just something that is historically inviolate. Okay, when you have more money printing, then you have lower population, and you cannot really replace population cycles, because the curve, the pyramid of fewer people at the top, fewer people who are aged, let's say 70, 80, 90, and a lot of people at the bottom, so who can support the economy, who can grow up to support the economy, that population curve just completely breaks down. And now let's have a look at the US women at the ages of 40 to 44, the childlessness rate. Okay, so what we're looking at is medical improvements here. Okay, and this actually goes against what I was saying, but what we are looking at is medical procedures becoming so much better that now people are having more kids even down the line. But what we are looking at, total fertility rate. What we are looking for are total fertility rates. Not specific cohorts. So that was basically just showing us what happens when people have more medical situations or more medical facilities available to them, and they can delay pregnancies, they can delay childhood or beginning the families, and that's actually true. But what we are looking at is total fertility rate, and then we are going to look at the population curves. My point is that this whole curve shifting or the population decline is global, not just in the US. It's actually being front run by South Korea, then Japan, and that is also correlated to just money printing in general. So that's what happens, and what that means is that this is going to continue to happen. So total fertility rate in the US has fallen from just above replacement, about 2.808 births per woman in 1990, to roughly 1.62 births per woman in 2023, with most of the decline occurring after the mid 2000s. Okay, look at this total population fertility rate. Okay, this is the annual total fertility rate graph. It's going to continue to go down. Now let's ask some follow-up questions. Find me historical breakdown of correlation between fiat printing and declining TFR. So what we are saying is, long, if any, exists. So what we are saying is, over the long term, historically, globally, if there are no Now, I'm doing this research with you, so bear with me for a moment. Compare data. Okay, it's saying there's no studies that have been conducted that provide clear data. Compare data. Historically, does TFR correlate to, or do population declines correlate to long-term money printing and fiat currency patterns. That's the best way I have for that right now, of framing that right now. But is there a correlation between money printers in any economy going and then declining birth rates? Okay, it's going to continue to decline that. Again, you have to understand AI is a very biased thing. Yeah, AI is kind of biased based on a lot of guardrails and a lot of agendas it has. But let's do modern charting, if you will, for major global economies today over the last 4 decades. Okay, we're looking at the more recent data. Let's see if it does it. And I don't need you to find correlations that have been studied. Just run your own analyses. How do let's say M2 supplies or monetary bases being expanded correlate with population growth rates for Japan, US, Europe, South Korea, and more. Okay, let's see if it does that, but AI is kind of biased there. Let's see what it does. I have to ask it now. So this is the kind of thing that happens with AI, which is why they're kind of safe right now. AI is not going to be able to replace that for everything, because to run these analyses, and this is kind of interesting because you're going to run into this situation all the time. If AI is guardrailed or biased towards presenting data or not presenting data objectively, and there are biases introduced deliberately by the founders of each AI, what do you have access to? Public records. Just pull up and analyze what you can. You're going to find that the data pulling, even if it's possible, give me rough, we'll do final data later. Only US, Japan, South Korea. Can you provide a rough chart? I said rough chat, I should have said rough chart. See what happens here. So what it's saying is, for Japan, rough pattern. United States, money stock rises steadily, population growth line slopes gently downwards but stay greater than 0.4%. No obvious year-to-year co-movement. Big M2 spurts do not show up as visible population growth breaks. What it's saying is that if you have expansion in the M2, there is no visible correlation between the charts. Do the long-term trends seem clear though? If not, since you're not willing to provide the charts. Yeah, so you see here, this is an evidence of bias and guardrails right here, but it can still not deny that. So in summary, long-term co-movement is apparent, but causation or strong direct correlation solely driven by monetary expansion is not established or evident in the data alone. So it says over the past 4 decades, M2 or broad money has consistently expanded in the US, Japan, and South Korea as part of the fiat monetary regimes and financial development, which is money printing, money printers going burr. During the same period, population growth rates in all 3 countries have slowed markedly from moderate positive growth in the 1980s to low or near zero growth today, turning negative in Japan. This creates a rough negative association over time, rising money supply versus declining population growth. Now, it has to provide this data objectively, even though it's not going to pull that data for me, and I can pull that data out myself in CSV format and have the analysis run for you. This is actually true, and you can look at the data yourself, and I'll try to do that in one of the future streams, so subscribe if you're not already subscribed. However, it says this observed pattern is heavily confounded by deeper structural factors such as aging populations, urbanization, changes in labor force participation, so on and so forth. So it's hedging. So I can see that you're hedging, possibly due to guardrails, but you're clearly contradicting yourself. And this goes back and forth with the AI, so there's only so much time you should be wasting with AIs, but this is actually what's going on. When you have over time, and this is something that is undeniable, just look at the population graphs or the population growth rates graphs, and then also look at how the monetary bases are being expanded in any particular economy, and yeah, that's what you get. The trend aligns negatively. Monetary growth continues while population growth collapses from positive to near zero or negative. US is milder but still downward. No hedging this, and yet you won't chart it. This is hilarious. Anyway, let's keep going. Let's see if it comes back in charts. So this is, again, this is something that I wanted to touch upon once again. We touched upon this in our previous stream, but we are now looking at fungus that has evolved in Chernobyl reactors, where, you know, life was supposed to not be possible at all. Nearly 4 decades after the 1986 nuclear disaster, researchers continue to find the organism clinging to the interior walls of reactor 4, where radiation levels remain lethal to humans. What sets this fungus apart is not just its survival, but its apparent ability to convert deadly gamma rays into chemical energy through a process scientists are now calling radiosynthesis. And this is growing towards danger and the future applications. Well, the point here is that nobody knows anything. Experts only really know very little things, very few things within the periphery of their field of experience. What is invisible is unknowable. This goes on to ask me, or this goes on to lead me into asking this question on whether there is life on Venus, because do we know anything about it? Can we observe it? Why do we know that life as it should be must be observable to us using the tools that we have? The argument is not about where life exists. There might be actually life on Sun. I'm not saying there is. I'm not saying there isn't. I'm saying, how would we know? We have categorized life into what is observable to us, what we can clearly see, but we don't have the tools to observe everything everywhere. What's happening underneath the surface of Mars is kind of unknown to us, or even underneath the surface of the Moon. In many cases, right under our own feet. The experts don't know what's going on for us right here on Earth. Every day something new is discovered. The experts did not know, and there was a tiff between NASA and experts of all kind about that 3I Atlas interstellar object that was exhibiting weird behaviors. We talked about that all the time. The point is, nobody knows what's going to happen over the short term, especially, and even the long term. But long term, what we have seen are patterns right here. So let's see what... All right, finally, we got a chart. That's what we were looking for. So this is the population growth chart. And as you can see, this blue chart right here, this is population growth. And this is M2. The red chart is M2. And you can see the correlation right there. M2 growth, when it goes up or the monetary base expands, population goes down. That's all I was looking for. And you can see all the rigmarole that we had to do to go back and forth with AI, because seemingly it had some sort of barriers against presenting this data to us, even though I said rough data is fine, just find me correlations. This goes back all the way to Rome. If you push AI enough, you can do that. If you can find numbers back from that period on your own and run the charts yourself within Excel or any program of choice, you can see that over time population goes down when you just keep expanding the monetary base. Why? It's kind of obvious, isn't it? If it's too hard or expensive to afford children, then you're not going to have children. And when that becomes true and compounded, if AI ever becomes good enough where it can actually do the job that human beings are doing, it doesn't have to be objective about it. It just has to do a job, even if it has bias or agenda. If it can do coding, if it can do creative work, if it can do productive work, then kind of human beings are not going to be able to fare very well, because when the utility goes down, people are just not hired anymore. If you're unemployed, are you going to have kids? How are you going to support those kids? Now, there are talks about universal basic income. We've been hearing about those for decades, but we haven't seen that play out. And even if it does play out, all that means is that the government deficit is going to increase, because now they have to pay everyone who can't find a job. I don't even know how UBI would work if it did work, but over time, monetary base is going to continue to expand. Fiat printers are always going to continue to go burr, and things are just going to get increasingly harder for the lower side of this K curve right here, which we are looking at right now. The middle class is shrinking. You're either someone who belongs to this part or someone who belongs to this part, and there's not a whole lot you can do when you are down here. Your options continue to shrink, because what are you going to do when AI can do your job for 1/100th of the price, and it can do it without taking a break, and it can do it at 50 times the speed that you can do it at? Where's the value proposition? Okay, let's keep going. MTV is now shutting down international music channels by the year end, and over time, I keep saying over time, all altcoins go to zero against Bitcoin, and all individual stocks also go to zero against SPX. Look at any major stock. I'm not saying they didn't have they did not have their run during their heyday. Of course they did. Nobody's arguing that. I'm saying over a long enough period of time, everything dies and everything tends to zero, which is what gets me to think about the businesses that have thrived for hundreds of years. The oldest businesses in the world right now, I think, are some of these Japanese shops in Japan where they sell mochi or some other sort of ice cream that has been going on and going strong for 800 years. These businesses are almost 1,000 years old. And in our upcoming streams, we are going to analyze why I think they have survived while major giant corporations that dominated the world at one point of time no longer even exist, or exist as a shell of their former selves. And finally, again, goes on to show you how much uncertainty there is in the market. Gold has hit a 6-week high as dollar has weakened and Fed cut. Well, we don't really know what's going to happen with the federal meeting next week, right? With the FOMC meeting next week. So that brings us to the end of the stream. I just wanted to talk about the massive crashes in the Bitcoin price that are happening today and why I'm actually excited about those. Because if those play out, if we have some more headwinds, then I'll be able to buy a whole lot more Bitcoin at much lower prices. And if it does go up, then I'm going to find entry to get more Bitcoin right now and see how it plays out over the long term. At the end of the day, all these markets are more governed by the macro conditions than narratives, than whatever else you think is going to happen. But on a long enough period of time, we've seen this with SPX, we've seen this with gold, we've seen this with Bitcoin, we've seen this with real estate even though we have now declining population graphs worldwide. Real estate continues to get more and more expensive, and the reason for that is primarily monetary policy or money printing. Things just keep getting expensive. Everything is more expensive and it will continue to get more expensive. In fact, when I buy Sony cameras at the same price today that I used to buy their flagship cameras 5 years ago or 10 years ago, it gives me an enormous amount of respect for the engineers and the people who are basically building this stuff. Why? Because They've been able to keep the prices flat while everything has gotten more expensive. Research and development has gotten more expensive. People or human resources or human labor has gotten more expensive. Raw materials have gotten more expensive. Transportation has gotten more expensive. Packaging, even paper, has gotten more expensive. And yet everything continues to stay at a flat price. So Canon, their 5D line of cameras, which is their sort of semi-pro line of cameras, has been priced at $3,500 to $4,000 for 20 years now. And that's just amazing. That just goes on to show you what technology can achieve for us, can help us accomplish. But that is not going to hold true when AI is able to replace you in whatever it is that you do. If you have a job or if you're a business owner, then technology eventually is going to get to a point where AI is going to enable you to fire a lot of your employees. It is what it is, even if it doesn't sound nice. And while there are a lot of problems with AI, as you've just seen in today's stream, these problems are very marginal to business owners who are just trying to get a task done. And you can train your own AI models as well on specific data, on specific procedures. If you are in the legal field, for instance, and you don't want to interact with API-based LLMs such as Perplexity or Claude or ChatGPT, what you can do is you can just have your in-house trained AI take care of the tasks that you wanted to take care of. So that brings us to the end of today's stream. I hope you enjoyed this and you enjoyed the hiccups we had with AI. It was a great demonstration of what happens when you deal with AI today. But is that always going to be the case? That remains to be seen. My name is Lakshya Behl. This is Behl's Business Broadcast. I'll see you in the next one. Have a great day.